Hello, everyone, and welcome again to Lifespan Investment Series, Episode 5. Joining me again is Jonathan Payne, author and publisher of the Payne Report. Good to see you again, JP. A lot's been happening since we last did this 3 or so months ago in April. How's it all going, mate?
It's going well, thank you, Eugene. I know it's amazing how time flies so fast these days. Perhaps it's because I'm getting a lot older, and so time is kind of accelerating, Eugene. Well, that's what it feels like for me.
Indeed, I share that. All right. Unfortunately, wish we were getting younger. So jumping into it, instability in all corners of the globe seems to be one of the themes, and we've also got elections happening, obviously in Europe and the UK, and then of course the mother of all elections that we're going to have later this year. Maybe you could give us a bit of a recap on what's been happening there.
Well, Eugene, you're absolutely right. I don't really know where to start. I'm afraid I'm a bit of a politics junkie, so it's probably not the kind of thing I should admit, because I know there's a few people watching us today, Eugene. But I am fascinated by politics, and I quite happily sit and watch election results for 12 hours non-stop, which was the case with regard to the United Kingdom. But okay, yes, we had very interesting elections in France, very, very interesting elections in the UK. But as you say, the mother of all elections awaits us in November, and I can't wait. However, obviously, all eyes in Washington, in fact, I reckon the eyes of the world were on 90 minutes when Donald Trump and Joe Biden had that presidential debate. And I don't know how many of you watching this watched the entire 90 minutes. I watched it all, and I think it's one of those expressions, what has been seen can't be unseen. And obviously, Joe Biden, the president, had an absolutely appalling debate. Full stop. It doesn't matter whether you like or dislike Joe Biden. It was a complete catastrophe. Since that time, there's been a movement within the Democratic Party itself, amongst the leadership, to ask Joe Biden to step down. But as we know, and I've written about this, in fact, in my Payne report, initially actually in February of this year, there's only one person who will be able to tell Joe Biden to step aside and not contest the US election in November, and that is his wife, Dr. Jill Biden. For the moment, the Biden family are standing firm and basically urging Joe Biden not to withdraw his candidacy. And so that's the state of play in Washington. But a couple of quick observations. First and foremost, I still believe Trump will win the November election. I said that many, many months ago. And the events following the Biden debate debacle has only strengthened my degree of conviction, because as you all know, ignore the national opinion polls. That's not the way the electoral system works in the United States. The president is elected by an electoral college, and therefore you've got to look at the critical battleground states. And obviously, Wisconsin, Michigan, Pennsylvania, Nevada, Arizona, North Carolina are the critical battleground states. And at this moment in time, I have Trump leading in all of the core 7 battleground states. That will secure him a second term in the White House. So don't look at the popular opinion polls. They're irrelevant because of the calculus and the nature of how the Electoral College works. So a couple of very quick observations, Eugene, if I may. If we assume, as I do, that Trump is going to win in November, we've got to brace ourselves for a second Trump term. We know a lot about Trump already. We know that he's going to implement tariffs pretty much across the board, but particularly against China. We know that he will continue a very aggressive fiscal stimulus program. But of course, Biden's already delivered that. Net, I think a Trump presidency will be at the margin inflationary. Also, Trump doesn't like a strong dollar. He thinks that countries that have weak currencies are kind of cheating in terms of their exports. So he doesn't like a strong dollar. Furthermore, he doesn't like high interest rates. Which property developer do you know likes high interest rates? And I believe, and this might be a little bit controversial, I think he'll have a fireside chat with the Fed chairman, Jerome Powell, soon after he wins the election in the end of this year. And once he's inaugurated, post January the 20th, 2025, he'll bring in Jerome Powell and he'll ask him to lower rates. I know that might sound a little bit controversial, and I then believe Jerome Powell will resign. If Jerome Powell doesn't resign, I think Trump is going to fire him. So, you know, I put that out there, and obviously I'd probably make a fool of myself yet again, having said all of that. So ultimately, I think a Trump presidency would at the margin be somewhat more inflationary and, of course, also very protectionist. So I think we can begin to instill that into our thinking about investment markets. Briefly, the UK, the Labour Party won a landslide. I think they won 411 seats out of a potential 650 in the House of Commons. The Conservatives were completely and utterly wiped out. So obviously Rishi Sunak has stepped aside, and we now look for a new Conservative Party leader. I don't think anyone is rushing to take that poisoned chalice anytime soon. But anyway, suffice to say, we have a massive Labour Party parliamentary majority. One little statistic for those of you who care about elections and politics. Here's one for the record book. 1/3 of the British electorate voted for the Labour Party. And yet the Labour Party won 2/3 of the parliamentary seats. I'll say it again. 1/3 of the electorate voted for the Labour Party, and yet they secured 2/3 of the parliamentary seats. So that's one for the record books. That's never happened before. Quickly across to France. Yes, this is another nation I get pretty excited about when it comes to politics. I used to work for the French. I used to pop across the channel when I worked for Paribas, one of the top French investment banks. Worked there in London for them and popped across to see my colleagues in Paris. Very pleasant as well. Lovely little bars and restaurants in Paris. And so I've got quite an affection for all things French. And one thing I learned very early on working for the French was that you have to be French to understand French politics. It is the most confusing and complex political system in the world. Anyway, we had the second round on Sunday, the parliamentary elections. If you remember, Emmanuel Macron, you know, devastated all of us by this dropping this bombshell, calling an early election for parliament. And the first round, Marine Le Pen and the National Rally, you know, won the largest amount of votes. Then everyone ganged up on Marine Le Pen and her party, and we saw this remarkable outcome. The new Popular Front, which was a brand new grouping that was a coalition of the Greens, the Socialists, the Communists, and none other than Jean-Luc Mélenchon, who I hope you are all very familiar with, would make a communist look moderate. He is probably the most radical politician that we've seen in France for many, 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 many decades. And now Mélenchon is, heaven forbid, I shouldn't say that, should I? I shouldn't say heaven forbid. It sounds like I don't approve of Mélenchon. But I mean, let me just say this. Even the members of his own party don't like him. No one in his coalition likes him. They are all terrified of him. So he will not be the next premier of France. But the bottom line is France now faces a period of instability as we approach the Paris Olympics. I'm not really sure where this is going to go, but I'm afraid these are the things we need to think about very carefully. France is a key foundation of the European Monetary Union. France also has horrible fiscal and budgetary arithmetic. The French government debt to GDP ratio is 110%. The budget deficit is 5.5%. They have breached all of the criteria for membership of the European Monetary Union. But of course, they got away with it because they're French. So Moving forward, the EU is now looking to discipline France and have actually issued a proclamation only 2 weeks ago saying that France has to reduce its budget deficit. Let me tell you right now, if the European Union goes to Jean-Luc Mélenchon, a diehard communist Trotskyite, and tells him to reduce debt, he will tear the piece of paper up in front of their face, because his fiscal agenda is to significantly increase debt. So basically, the French capital markets now are having to try and, understand and recalibrate and try and get a sense of what is going to be the outcome. Who's the premier, the prime minister of France going to be, because we haven't made a decision on that yet, and how much power will Mélenchon and some of the radical left have in this new parliament? So it's a really interesting situation right now. I better stop there, Eugene, because you can see I'm getting overexcited.
Sounds like a complicated mess, really, in Europe. And it's interesting. It's interesting what you were saying about the US election. We've talked, and there's been a lot of public commentary of people who feel that, and I think you're in this camp as well, that Jerome Powell wants to cut rates to try to reduce the odds of Trump winning the election, and that's a nice segue into the next thing we want to talk about, which is essentially US inflation. We've got an inflation number coming out on Thursday, the 11th of July, US time, I suppose. And what should we expect given the slight slowing of inflation in May in the US? That is 3.3% down from 3.4%. So inflation does seem to be at least stabilizing in the US. So, what, and then you've got a slightly softening labor market also. So, what are you thinking in terms of inflation in the US, and then interest rates, and then maybe we can sort of circle back to how the US election might influence that. You've already said what you think might happen after, which is interesting. I wonder what that looks like, but Trump is probably going to want big rate cuts, not sort of a 0.25%. He's probably going to want, couple of 100 basis points, and that I think will be a challenge unless inflation really takes a dive. So what are your thoughts around inflation, interest rates in the US, JP?
You stole the words out of my mouth. So you and I, Eugene, we talk about basis points.
Yeah.
Trump talks about percentage points.
Yeah.
So when he has a fireside chat with Jerome Powell, and by the way, I would love to be a fly on the wall, because just between us, Donald Trump despises Jerome Powell, and that feeling is entirely mutual. It is well known in Washington that Powell really doesn't like Trump. And we know what Trump did to him via his Twitter account when he was the president. And when they have that conversation, and Jerome Powell will be talking in increments of 25 basis points. Mr. President, we're looking to normalize monetary policy. And at our next FOMC, Mr. President, we're going to table the prospect of a 25 basis point incremental reduction. And he'll look at him and say, listen, you can talk basis points. I'm talking percentage points. I don't want to see your face here again unless you deliver me 200 basis points, none of your 25 basis points. Okay. I really do honestly believe there is going to be a real clash if Trump wins, and it's something I believe. Last night, Jerome Powell delivered a statement to the House, part of his annual testimony, and he was relatively ambivalent. He said there was some progress in inflation coming down. Obviously, their target is 2%. He also acknowledged a little bit of weakening in the employment market, which I think is self-evident in the non-farm payroll numbers. But as you say, the all-important number is our time tomorrow. If you're in Australia watching this, is 10:30 p.m. Australian time. So I'm sure you'll all stay up after watching Married at First Sight. I think they ended the season, which is rather sad. But US CPI at 10:30 tomorrow night. And so the market's looking month-on-month CPI for a rise of 0.1%, and that would lower the year-on-year rate down to, what is that, 3.1%. But the core number is probably the more important one. So on the core number, the market's looking for plus 0.2% month-on-month, and that would leave the year-on-year core rate unchanged at 3.4%. To me, that's still quite a long way from their 2% target.
Yeah.
So they're going to need more evidence of a deceleration in the rate of inflation. But if you look at the market pricing for the meeting, the market is now 75% pricing that the Fed will cut by 0.25%. And I can kind of see that. You said it yourself just a moment ago. I definitely think Jerome Powell would like to cut rates. And I'm sure, well, I know you know, that the talk amongst the hedge funds in the US is that Powell really, really, really wants to cut rates because he's going to do everything he can to stop Trump getting into the White House. Now, you can think that's a conspiracy theory, but I'm probably rather partial to that perspective. So yes, Powell wants to cut rates, and once he gets an excuse to do so, he will do. And I think also just around the edges, we're beginning to hear a little bit more commentary out of the Fed and its members of this weakening in the employment market. And I'm seeing that. I'm certainly seeing a weakening in the US employment market.
Okay. So, yeah. So and I think the market's pricing in a good chance of a rate cut in September in the US. But yeah, it's hard to see drastic rate cuts in the US until the inflation numbers head much closer to that 2 or even 2.5% target in the short term. But it's a far cry from 6, which is what was being priced in 6 or 7 or 8 months ago. So okay. So and then you mentioned the softening of the labor market. What are your feelings around a recession in the US at the moment?
Yeah, I'm really reluctant to ever use the R word ever again, because I made such a fool of myself last year, and I'm still, I'm covered in bruises from that experience. It's been traumatic. So I was, on record in 2023. I don't know why I remind people, but I suppose I have to. I was calling for a recession in 2023. We clearly didn't get one. But there's a clear deceleration in the economy at this moment in time. I think the Atlanta Fed, the so-called GDP now, estimates around 1.8%. What was the first quarter? Was it 1.3, 1.4%? So, and that, don't forget, America produces an annualized GDP number. Everyone else in the world does an absolute Q on Q. America, for some reason, annualizes it. So de-annualize 1.4%. It's
3.4.
So the end of the day, I'm seeing a deceleration. I am still definitely in conservative camp with regard to the US economy. I have to acknowledge the resilience. I was wrong for a range of reasons. First and foremost, I underestimated the quantum of fiscal stimulus. I underestimated the resilience of the nation of shock till you drop. But we now know, of course, we have confirmed that all those excess savings they built up post-pandemic have now been spent. And we're seeing, listen to company results. All the retailers, particularly fast food, McDonald's and others, are really warning about a softening in consumer spending. And we know there's huge dispersion within the United States in terms of households. The high-income households, happy days. Strong stock market, strong house prices, everything's fantastic. And if they've got excess savings, they're actually now getting a rate of interest on it for the first time in a long time. The low-income groups are getting absolutely hammered. High inflation, because they look at cumulative inflation since 2020 to now, up 25%. More than that, I think, across a range of goods that they have to buy, the kind of pure necessities. And then, of course, they've got high levels of debt. We can see it in the credit card data. We can see it in auto loan delinquencies rising. So the lower income quartile, if not half of the US household sector, is really experiencing a lot of pain at the moment. The high income groups, happiest they've ever been. So that's the dispersion. But as time goes by, we all know from history that there is a lag between the rise in interest rates and the impact and the filtration of and transmission of that monetary policy through the economy. And I think it's now coming through. So I'm afraid I'm still very much in the more negative camp. If you took the 68 economists across the United States, there's only a few of us who are basically saying we are heading south in 2024. That's the numbers I'm looking at are telling me that. But obviously the consensus amongst, the Ivy League chief economists at Goldman's and co, they're all saying no such thing. They're all looking at a robust economy. I beg to differ, but I was wrong last year, so I have to bring that caveat in. And it's kind of a forecast I don't really want to be right about, but I am seeing a much softer economy than the great majority of economists.
Yeah, I mean, and look, a lot of people were predicting a recession in 2023.
That doesn't make me feel any better.
Sure. But I mean, in some ways, it's probably a more contrarian call now than it was a year or 18 months ago. I've heard a lot of people refer to it as the most anticipated recession of all time 18 months ago. But throw in all the COVID savings, I think that was probably one of a very unique scenario that's probably kept the consumer story going. And I am seeing a lot of stats that suggest that a lot of that is now exhausted. So we could just be seeing a much more drastic lag than we have. But yeah, you can't deny the fact that the government reaction has helped, and everyone has, the consumer has proven to be very resilient. So turning now closer to home, which is in Australia, and we're talking about Australia here, which is quite different. Inflation does seem to be proving to be much more sticky. We had a fairly, well, you might consider it a hot inflation reading a couple of weeks ago, where inflation came in at 4 or 4.1% in Australia to May, I think it was. And so, what are your thoughts about Australia in terms of inflation and potentially in terms of interest rates? I mean, it's probably unthinkable that rates are going to go up in the short term in the US based on the current data. There'd have to be quite a change in data, but in Australia seems to be a bit more plausible that we could get maybe another. There's people talking about 2 or 3 rate cuts out there in Australia because inflation is just not coming to where it is. So what are your thoughts closer to home, JP?
Well, I think, and we discussed this at our last investment committee meeting, there is a real conundrum facing the RBA, the Reserve Bank of Australia. And Michelle Bullock, the Reserve Bank governor, has articulated some of that conundrum to us in her recent press conferences. The end of the day, I don't think the RBA wants to raise rates, but you're absolutely right to highlight that very naughty May CPI number we had. So just to remind everyone, the May consumer price inflation, this was the monthly report, because as you know, we now have monthly CPI numbers. The big number obviously is the quarterly, but the monthly is still important. The monthly CPI number in Australia for May came in at 4%. 4%. The market was anticipating 3.8%, and that is up from 3.6% on a year-on-year basis in the preceding month. So quite a bit above expectations. And that led to a rapid recalibration of interest rate expectations in Australia. And the market then started pricing no rate cuts by the RBA in the remainder of 2024. And in fact, attaching, like a 35% probability, not a 400% probability, 35% probability to the RBA having to raise rates. I don't think the RBA wants to raise rates, and it's the last thing that we in Australia need, because as we all know, the Australian economy is literally growing at the zero line. We grew 0.1 of 1% in the first quarter. I don't know why the ABS just didn't call it zero amongst friends. The bottom line is we have very, very weak economic activity here, and we really don't need high interest rates. But the Reserve Bank is obligated to maintain a restrictive monetary policy if inflation remains at these levels. And we know if we break down the inflationary data, there is some real sticky service-based inflation, and that has the attention of the Reserve Bank. And I'm afraid, they services inflation is a bit like toothpaste. Once it's out of the tube, I don't know if you ever try to do it, Eugene. I'm sure you have tried, like I have. Try and put toothpaste back in the toothpaste tube. It's impossible. Once it escapes, it's a real problem to deal with. And that's the dilemma and the conundrum facing the Reserve Bank today. So my view is Michelle Bullock doesn't want to raise rates, but if we get a really cheeky June quarter CPI number, if that number comes out, and that I think is published at the end of July, if that number is slightly higher than market expectations, then I'm afraid the Reserve Bank might feel the need to raise rates, which we really, really don't want here. And I think that means we're pretty much almost in a recession here in Australia. We're very much on the zero line. And I think, unfortunately, if the Reserve Bank has to raise rates, I think it doesn't look good here.
Yeah. Let's not forget, we've been in a per capita recession in Australia now for, I believe it's 5 quarters.
I think you're right. I think you're right. I think it is 5 successive quarters. Yeah.
I mean,
the worst since the 90s.
Yeah. I mean, if we were talking about 5 quarters of overall negative growth, I mean, we'd be talking about a depression. So the household is really feeling it. The only thing that's keeping the economy above, negative growth is migration. So which has been unprecedented, and one question is whether or not it's going to continue at the sort of levels it did last year. So I don't know. And the other part of the Australian economy jigsaw puzzle, I suppose, is the fact that mortgage holders in Australia are mostly on variable. There were a large number that went on fixed rates during COVID at levels of around 2%. You're now looking at levels of closer to 6 or more percent. And then, of course, you have the COVID savings. But the fact is, those interest rate rises flow through to the economy much faster in Australia. We've proven to be pretty resilient as well. But would you think that the risk of an actual recession in Australia is significantly higher than in the US, partly because of that, and just partly because the numbers that are coming out of Australia, inflation's higher, GDP growth is lower? What are your thoughts there, Jonathan?
Yeah, look, I think those points are all very well made. It's self-evident that it's in the numbers, and you and I are not making this up. Australia is in a very deep per capita recession.
Yeah.
If we hadn't had 700,000 new arrivals in Australia last year, we know that the economy would be in recession. So, that's what the per capita GDP number tells us. Now, moving forward, there's a lot of talk in Canberra that Australia just can't deal with that sudden influx of new arrivals, and in such a short period of time. There's a huge burden on housing. I mean, look at rents, housing shortages. I mean, the younger generation in Australia is being completely priced out of the housing market, and they can't afford to buy a house, but they can't really afford their rent either. And unfortunately, they're really caught. They're in a horrible economic pincer, and you talk to the younger generation in Australia, they're angry. Yeah. Oh no, the higher income lot. Oh no. By the way, none of them are here anyway. They're all in Europe on holiday. I mean, I can't tell you the number of people that in that higher age bracket are all in Europe, having a fabulous time. Usually, I don't know why we're not there, or maybe we're not old enough. Well, certainly you're not old enough. I am old enough. But they're all in Europe. They're spending all their super and savings in Europe. So again, we've got that big dispersion here. Look, if the Reserve Bank goes on a tightening regime, I think we definitely head south in terms of the economy. As I said, we're only growing 0.1% on a Q-on-Q basis. So it won't take us a lot to trip through negatively through the zero line. And for the remainder of this year and into next year, I will guarantee you that Canberra will act to reduce the amount of migration. We'll go back to a more normalized number moving forward. So we won't have the benefit of that massive influx of migrants, and I immigrated here in 1997. What do you do when you arrive in a new country? You go and buy, what do you buy? A washing machine? Sofa? Yeah. I mean, I won't go through the full list because I probably didn't actually go into the shops myself and buy them, but they appeared somewhere. So, I mean, there's a huge amount of stuff that you go out and buy when you arrive in a country, let alone what about a house and all of that.
So let's talk a little bit about our positioning and our views on equity markets and bond markets, Jonathan. So, we've discussed for the last 20 or 30 minutes about how we feel about, recession and interest rates and whatnot. What's your view on the state of equity markets and looking forward? What do you think?
Yeah, Eugene, I think the equity markets are about as fascinating as I've ever seen them. And we've seen this extraordinary concentration, and everyone knows about this. I'm stating the obvious. The so-called Magnificent Seven, it became the Magnificent Six because Tesla started underperforming, and suddenly Tesla rose from the dead. I'm not quite sure how they've done it. And Tesla's been a standout performer just in the last 3 to 4 weeks, and Apple actually has also performed quite well for various specific reasons. But bottom line is, the US stock market's been led by one company, which is the greatest company the world has ever seen, and it begins with N. It's called NVIDIA. We all know the narrative. We know the story. I've been personally very, very excited by that name and the whole AI revolution. But NVIDIA is taking a bit of a rest, and so some of the others are picking up the slack. But the bottom line is the kind of dispersion and relative performance in the United States that we're seeing today has never been seen before. I really choose my words very, very carefully. I was very much part of that 99 situation. I saw Cisco become the most amazing company, and then we saw what happened next. By the way, just for the record, NVIDIA is not Cisco. NVIDIA is an amazing company and actually will continue to perform remarkably well. But everything gets to a point where you kind of say, okay, fine. I love the company. I love the fundamentals. I love the earnings prospect. But what about the multiples? What about the share price? Up 157% year to date on NVIDIA, the locomotive of the US stock market. And I think, and I articulated this in my most recent report, that we're getting ever closer to that kind of zone of being priced for perfection in terms of the United States. It's a momentum-driven market. I understand that, and I respect that. I understand that those big names, whether it be an Apple, a Microsoft, a Google, an Amazon, and NVIDIA, obviously, or even a Tesla, it's one of those situations with everything that's going on in Europe, for example, what's going on in China, for example. Global investors look at the United States and they say those big tech stocks are the prettiest house on a really ugly global street. I get all of that, but valuations are stretched. Anyone would have to acknowledge that. And the longer we're in this game, Eugene, the more we need to respect those extremes, because valuations and price earning multiples are like rubber bands. And they stretch. And everyone says, it's fantastic. Everything's going to carry on. And then woof, they come back in. So I think the price earnings multiples in the US are somewhat stretched. I think clearly we've seen a massive dispersion between small cap, large cap, and within large cap, we've got this concentration within those spectacular 7 names, the so-called mega tech and mega caps. I'm more cautious on the US because of that valuation multiple. And as I said, I think we're kind of in that zone of being priced for being priced for perfection. With regard to bonds, I've been kind of neutral for the balance of 2024, and the portfolios, have become more neutral. They were quite overweight duration, and they've been now moved back to a more neutral setting. And I think they've done quite well out of that
Yeah.
because bond yields have actually risen in the last couple of months. And those changes were implemented over the last several months to move to a more neutral setting in terms of the modified duration profile on the portfolio. So I think that's worked reasonably well. The debate around bond yields is predicated upon the following. We've got this tug of war. What is the tug of war? The tug of war is we've got the United States with a big budget deficit, very high levels of debt. We've got the Congressional Budget Office, which is a nonpartisan organization, basically saying or ringing the alarm bell on excessive debt in the United States, ringing the alarm bell on the interest cost, which is now annualizing at $1 trillion. So about equivalent to defense spending, or actually exceeding defense spending around now. So the CBO is saying the path that the United States is on is an unsustainable one. The fiscal path is unsustainable. So the US Treasury has to keep issuing more treasuries. Excess supply, all things equal, drives up yields. On the other side of that, what's the demand side of that equation with respect to US Treasuries? On the demand side, first cab off the rank is the US Central Bank, the biggest holder of US Treasuries, and we know they're implementing quantitative tightening. So they're reducing their holdings in US Treasuries. The next one, of course, is Japan and China. China has been reducing its holdings in US Treasury securities, and Japan's been kind of neutral, but slightly reducing their exposure. Then you've got households in the US, and their exposure to treasuries has been building. Why? Because, of course, we've seen this ratchet up in the yield. So, for example, money market funds in the United States have big exposures to US Treasury bills, because US Treasury bills now offer 5.35, 5.44%. So that's nice. That's a positive. So we've got this constant tug of war, and I'm kind of neutral because I respect the budgetary fiscal arithmetic and the impact, commensurate impact on bond yields, shifting them slightly higher. But on the other side, I see households being quite happy accumulating, particularly short-dated treasuries, because they offer quite attractive yields. And also, don't forget, we've got the economic slowdown story happening as well. So I think it's a kind of balancing act. Yeah. And I think the portfolios did quite well to move to a more neutral stance over the last couple of months.
Yeah. Thanks, JP. And yeah, and I guess that's reflected in our allocation. So, we remain fairly neutral with respect to bonds. Bonds with longer fixed duration, so long-term fixed rate bonds. And I think you summarize it really well in terms of the fact that there's two sides to that story, and it's hard to know exactly which is going to prevail. But on the one hand, locking in 4 or 4.5% for 10 years seems attractive, because I think over that period, probably rates come down, perhaps even if they stay higher a bit longer than expected. That's the thing. A rate rise or two, or a rate cut or two in the short term doesn't have a huge impact on the 10-year rate, right? So we remain neutral. And as we said in April, we did reduce our exposure in April to duration in both strategic and tactical. And then we reduced it a little bit further in tactical in May. Going back to equities, and it's another interesting conundrum. You've got valuations which are stretched in the US particularly, but then you've got that story of these gigantic 6 or 7 stocks in the US that seem to be accounting for a lot of the upside in the US indices. But then you've got like the Russell 2000, for example, which is a much broader index. It's 10 or 15% below its all-time high last time I had a look. So the smaller end of town, hasn't performed as well. A lot of it has been those really gigantic tech stocks. So it's tricky. And but and then you've got all the geopolitical risks, the stretching of valuations, the economic risk. So we remain cautious in our portfolio approach. I think also, and I think we explained this in April, our quality bias. So we want to be invested in managers that will buy quality stocks, so that if there is, an economic shock, um, or there is a geopolitical shock, that those companies that have stronger balance sheets and a bigger and have a better business strategy will survive. They might be volatile, but they'll survive. And you won't, the risk of long term or permanent capital loss is much, much lower, which is what we want. But we also maintain an underweight position. So we also, in the last few months, we've done a little bit of extra buying in tactical. We've increased our equity exposure a little bit, and we've now added an exposure to global REITs. So global property has taken a hit, hasn't performed in the same way sort of over the last 3 or 4 years that equities have. And the tactical portfolio didn't have any exposure to global REITs, so we've added a bit. So and it's again trying to strike a balance between how resilient markets have been to all the risks and those stretched valuations. If there is a contraction in P multiples, perhaps some of those quality stocks might take a hit because some of those valuations are also stretched, although not crazy stretched, because when you look at the earnings prospects of some of those companies, particularly companies like Nvidia, they're quite amazing, right? So because of what they're doing, the sort of businesses that they run, the fact that Nvidia doesn't really have a competitor, at the moment. They will over time, I would say, but for the time being, they're sort of they sort of can set their own pricing and whatnot. So you got a lot of things happening there. So we remain cautious. The tactical strategy is still very underweight. We've just moderated that underweight position a bit in light of the fact that we're probably a bit more, probably a little more optimistic, and sort of in respecting the fact that markets have been fairly resilient, right? But there's a lot of risk out there, and valuations are stretched. So we're still maintaining a significant underweight position, and we'll probably continue to drip feed back into the market. Obviously, as I've said, the tactical strategy does take a short to medium view, so that can always change, right? But for the time being, yeah, we're sort of moderating that underweight position a bit, but still remaining quite cautious and underweight in our growth exposure. And in SAA, in the strategic strategy, we haven't actually made a change since those changes in April, but we are reviewing a few of our holdings, a few of our funds. We are potentially looking at a global small cap allocation, and we're looking at a few other bits and pieces. So we'll probably have a little bit more to say around the strategic strategy at our next update in 3 months' time. But that's kind of how the portfolios are positioned. It is a difficult environment because, as I said, there's two sides of it. There's a lot of positives and a lot of negatives, and it's difficult. So we want to be diversified, and I think you want to have a quality bias at this point in time. JP?
I don't want to add to that at all. I think you summed it up perfectly. If I said anything, I would just dilute what you've said. I agree with what you just said.
Very good. All right. Well, this has been great. Thanks again for tuning in and for joining us. And Jonathan, thanks again for your input. Really wonderful listening to you go through your views, particularly a lot of the geopolitical stuff, which I think is above a lot of us, but it's so important and quite interesting as well. So it's been a great chat. And thank you to all of our viewers for tuning in. Thank you for your support, and look forward to doing this again in 3 or so months' time. All the best.
Thank you, Eugene. Thank you.